You hear a lot about how tariffs are a zero-sum game for the global economy. I mean, I strongly disagree with that. Tariffs are a negative-sum game.
And that's led to quite a bit of volatility in those names and countries and sovereigns and corporates when they're in the headlines.
It depends where you're coming from and what your reference point would be. And there are pockets of value there to be found if you're prepared to do your homework.
Hello and welcome to Fidelity Answers, the investment podcast where we tackle the pressing questions our clients, investors like you, are asking. I'm Ben Mashinsky.
And I'm Rosie McMellin. On today's episode, with credit spreads close to record lows, where can you turn for value in bond markets?
It's the big challenge for fixed income investors this year. Rosie, you've been speaking to a few clients about this. What sort of things are they saying?
Well, interestingly, there's a real mixed response to that question, and it really depends on who the client is, what their perspective is, and how they view their alternative investments. And to help us delve a bit deeper into that today, I've been joined by two of my colleagues who should be able to create quite an interesting debate because they come at this question from completely different perspectives. So I head up the fixed income portfolio management team, and I've got some of my senior investors with me. I've got Mike Riddell, who's got at least a couple of decades looking at macro investing in fixed income markets. So he looks at interest rate drivers and inflation and the world from a top-down perspective when he's investing his funds. And I've got portfolio manager James Durrance, who is very much a credit specialist and tends to focus on looking at individual companies in his investable universe and piecing together the best quality investments for his funds bottom up. So we're going to examine this argument from these two perspectives and see whether we meet in the middle.
Fantastic. Just to kick things off, Mike, we we live in interesting times. On a scale of 1 to 10, roughly how confident are you about where you have your money at the moment?
Times are always interesting. I think probably a little bit too interesting at the moment, sometimes day to day. I think looking at the funds that I manage, if you're talking about confidence in positions, I'd say we've got medium conviction. Now we'll get onto it obviously, but I think that there are some very interesting valuations in sovereign bonds where I think that the market should be pricing in more rate cuts than it currently is. But then on some risky assets to us, they look still a little bit overpriced despite the pullback we've seen in the last couple of months. So not all in by any means, but I think there are some very interesting opportunities out there.
Excellent. And James, how often are you checking your phone for market updates these days?
Very regularly. So, if you rewind only sort of 3 months ago to when Donald Trump won the US election, there was a sort of huge market narrative then about a US booming American economy and the propensity for sort of fiscal indiscipline that would take Treasury yields a lot wider. And conversely, there was a sort of a theme that Europe would go into a recession, there would be a trade war that would really punish Europe, and that European bonds would rally, so sort of European fixed income would rally. Fast forward 3 months, there's completely the opposite view in the market now, which is that the US is slowing down, Treasury yields are rallying, credit spreads are actually underperforming, and Europe appears to be going into a kind of boom scenario where defence spending is going to pick up, bond yields are under pressure, credit spreads are outperforming. So, in the space of sort of 6 weeks to 8 weeks, market narratives can change really, really quickly. Maybe that's partly due to who sits in the White House at the moment, but it's also kind of a reminder that just market narratives change all the time and always will do.
So, James, can you give us a bit of context as to why the valuations are where we are at the moment? We've seen, as you mentioned already, we've seen some really strong outperformance of corporate bond spreads. So the risk yield premium that you're getting for taking that credit risk has come right in for the demand because of the demand for credit. So can you just talk to us about what were the drivers to get us to where we are today?
Yeah, sure. So I think one of the sort of most obvious answers to that is that the macro backdrop has been supportive. So credit spreads typically perform well as long as there are no sort of major problems with the global economy, particularly the economy in the US and Western Europe, where the larger part of credit universes sit. So that's the backdrop. We've had a decent economic expansion that is continuing and has been broadening out, and that has encouraged investors to seek risk, so seek equity returns and seek credit and high yield returns as well. So the backdrop is supportive. I think what's changed and why credit spreads are sort of historically tight and continue to apparently grind tighter is that there are kind of new buyers in fixed income markets that are attracted by yield, not spread. So I think what's changed and what continues to change is the outright level of yields in the fixed income market is as high or as close to as high as it's been in potentially sort of 2 decades. And so people are very attracted, retail investors but also institutional investors are very attracted by those high levels of yields. And they're sort of looking at the spread argument a little bit less. But they do also want to have some risk on board. So they're not just trying to buy government bonds. They want to buy sort of, whether it's income or high yield or risk or what have you, but they're being paid and they're being compensated for that. So I think that's sort of a big driver of the argument, is that spreads are tight because yields are high. That creates risks of its own nature, which I'm sure we'll talk about as we go on into the discussion. But that's kind of reason number 2. And then the last reason I would say is that just the sort of technical picture. So technical, the word technical is the most overused word in the bond market. But
it means different things to different
people,
doesn't it?
Yeah, it does.
I suspect you're not talking about moving averages and lines crossing head.
No, what I mean more is like the supply and demand of bonds. So if you imagine that you are a sort of corporate, or even as a sort of private individual, do you want to get a new mortgage now? Probably not, because rates are as high as they've been for a long time. You sort of wish that you'd done your mortgage like 5 years ago, and if you have to buy a new mortgage now, you sort of you try and make it as short as you can. It's the same for corporate borrowers as well. So corporate borrowers don't want to issue debt if they can avoid it because it's expensive. So there's not that much there's not that much supply of bonds, but there is a terrific amount of demand for bonds.
That's really interesting. And we might come back to some of the more details on the technical side, because as you say, I think that's a really important part of the jigsaw puzzle. But let's just pause there and go to Mike, because it'd be interesting to hear, going back to the question I posed to James, like why are we where we are in terms of credit valuations from your macro perspective, and is the situation supportive enough to keep us at those type spreads? What's your view? Because I appreciate you see things from a different angle.
Yeah, in terms of credit market technicals, clearly that's James's area rather than necessarily mine. I think I'd always view it from macro fundamentals, and I absolutely agree with your point that credit spreads, and actually not just credit spreads, but other risk assets tend to move with just global economic growth. So when I look at credit spreads, we can invest in credit in our funds, but we can do things in inflation and rates and FX as well. What you've seen over multiple decades is that risk assets move in line with global economic growth. So credit spreads tend to be tight when the global economy is doing fine, as long as it's not too hot, but is doing well. And that has been the case for the last 2 or 3 years. So I think if you look at where risk premium are, where volatility is in markets, where credit spreads are, then I think you can justify it, given that growth actually has been holding up okay, and particularly in the US, where I think credit markets are particularly expensive. But I think what's interesting in the last few months is that credit spreads have stayed very tight, and James mentioned the technicals, but you have seen other markets start to price in risks. So you've seen a big increase in rate volatility. Government bonds have been moving around all over the place. Obviously Donald Trump being elected has contributed to that. You've seen FX implied volatility surge, which again you normally see it's like a recessionary indicator, if anything. And these things again normally are indicative of the market worried about volatility and worried about downside risk, and yet credit has stayed just bulletproof. So there's something else going on here. And I mean, from my perspective, from a very top-down macro view, if I want to allocate to financial assets, to risky assets, I want to get paid to do that. I want to get paid more yield, more carry, more potential return. And with credit, given that valuations are very tight, to me it looks like there's not much upside. I mean, they might stay where they are and they might even rally a bit. But there's not much upside. But if anything goes wrong, which other markets begin to signal, then there is potentially downside.
Mm-hmm. So that's interesting. And as you mentioned, we're starting to see some weakening in some risk assets. So when you're looking at your funds as an indicator of risk, what are the markets or the other asset classes that you would follow and you'd say, well, oh my goodness, there's a red light flashing here. I really need to reduce risk in my funds. How do you approach that when you're looking at markets on a day-to-day basis?
It comes really down that it's top-down macro process that we have. So the indicators to us are signs that the global economy is weakening, or the view that we think it will weaken more in future, clearly. And there's a whole load of macro indicators which I could discuss. But I think very clearly the US economy has been driving a lot of the strength of the global economy in the last 2 or 3 years, and that has been key to the behavior of risky assets globally, not just in the US. And there are clear signs that the US economy is slowing. I mean, bear in mind, growth in the US has been absolutely phenomenal since 2022. I mean, we were running at 3% GDP growth rate, or even much higher than that in sort of summer 2023 and into 2024. The market, I think, is now almost pricing in that the US economy, or at least until very recently, have been pricing in that the US economy will continue growing at 3% forever. And that is where we had a very strong conviction view that that was not going to be the case. I think a lot of the narrative around what Donald Trump and the Republicans might do in terms of driving growth stronger, I think we've seen a big unwind in that view. Tariffs are not necessarily good for growth, I'd argue. I mean, you hear a lot about how tariffs are a zero-sum game for the global economy. I mean, I strongly disagree with that. Tariffs are a negative-sum game. I think, and actually now people seem to be thinking, even for the US, which in theory people thought a few months ago would actually benefit from tariffs, now the uncertainty that businesses are telling you they will not invest because of the uncertainty. So just the threat of tariffs is actually causing an economic slowdown in the US. And that's just in the US, let alone those countries which are going to be hit by these tariffs. So I think that, as we see more evidence of tariffs, and we are now seeing tariffs imposed on various countries, that is going to drive increased uncertainty, which should increase volatility and implied volatility in risk assets. And I think that means downside risks to growth everywhere have increased. So coming back to markets, is that priced in? I think in credit, I'd say no, it's not priced in. In some other assets, maybe like emerging markets, and maybe evaluations actually are warranting inclusion in portfolios, which we can talk about in more detail.
Yeah, and maybe just coming back to the technical point that you made, James. One of the topics that got quite a lot of coverage, perhaps towards the end of last year, was this concept of a wall of refinancing risk. Can you talk to us a little bit about whether that's a concern for you in the companies you look at? Are you worried about refinancing, or is that a concern that's dissipated over the course of time?
My view is
maybe define a wall.
Yeah. So my view is that was the sort of catalyst that never happened really. So if you sort of rewind back to 2022, 2023, and you had this sort of explosion of both rates and spreads, and interest costs just started to go a lot higher, and there was a concern that a majority of companies would find it very difficult to refinance at levels of interest expense that they could justify. And it just never really happened. So, first the investment grade companies refinanced at higher rates, and then the high yield companies refinanced at higher rates. And there were only really sort of a handful of sort of names / sectors that really couldn't, they couldn't afford it, or they couldn't get access to market. And they had to look at LME, which is sort of liability management exercises, which is kind of a sort of soft way of talking about a default or an extension or a restructuring. So yes, some of those things have happened, but it's always been like a very small part of the investment universes that we look at. And most people have just eaten it. So that, as with the kind of mortgage example that I referenced earlier, you used to have a 2% mortgage, now you have a 5% mortgage, tough luck. You have to pay it, and I would say sort of 98% of the credit market have been able to withstand that and still can.
So in a risky environment, or potentially risky environment, that's one risk that we can perhaps put to bed for the time being.
Yeah, I mean, I wouldn't put it to bed sort of across all asset classes and ad infinitum. I think there will continue to be companies that struggle, because you still have some borrowers that are, have an average cost of debt of, let's say, 3% in Europe and 4% in the US, that it's going to pick up. And it will get higher, and it will be higher for longer, I think. But I don't think that that's going to, promote a big wave of defaults anytime soon.
I think wave is a key point, actually, because I was going to say that everyone always talks about a wall of maturity, but the reality is that wall is always about 2 or 3 years in the future. It's a wave. It moves within time. It's a moving wall. Exactly. It's not a wall at all. I think the only time that wasn't the case was in 2009, where obviously there was a massive crunch, and then people couldn't issue in 2009, and then therefore that did get that wave stopped briefly.
Yeah. But actually, that's a really good example, because in 2009, especially leveraged credit markets were quite in their infancy stage still, so they hadn't been around for like a massive cycle, certainly like that. And so companies didn't really know, they didn't do sensible things in terms of financing. They basically issued 1 year debt, 3 year debt, whatever, and so you have a 3-year recession, the whole thing knocks over. Whereas now most, I would say sort of sensible larger borrowers issue sort of laddered debt, right? They have some short-term debt, but they also have 5-year bonds, 10-year bonds, 30-year bonds if they're sort of crossover or IG. So people have kind of learned to manage their own maturity wall such that you don't get that kind of outcome again.
So as long as we have a fully functioning market, everything should be fine.
Yeah,
and even all bets are off.
Yeah.
Okay.
Yeah, and Mike, just bring it back to the macro factors. We talked about the US. Is in terms of themes, is that the sort of number one driver for you at the moment, or are there any other sort of big global themes that you're looking at?
Yeah, the US theme, I think, has been dominating everything. I mean, if you look at sovereign bond markets, which is a big part of what we do, bond markets have been incredibly correlated to treasuries over the last 3 years, not just the last 1 year. So I think, thinking about the themes, actually I'd wind the clock back not just 6 or 8 weeks, but actually back about 9 months. And we had in a situation where Q2 of 2024, the US was growing at 3%, everyone's very bullish on growth. And then suddenly we had a bit of a weakness in the US and the global economy. And we had one bad payrolls report, and then all hell broke loose. And suddenly the theme went from US going at 3% forever to hedge funds and leverage investors are all stopping each other out. And suddenly the market is pricing in an intra-meeting Fed cut because of the panic. And none of this made any sense, but this was all because positioning was so skewed one direction, which was for a strong US and US exceptionalism, whatever you want to call it. At one point, the market was pricing in 8 rate cuts over the next 18 months. And in, I guess, beginning of September of 2024, the market thought that the Fed would be cutting rates to 2.75%. And then what we saw was that blip in growth actually then rebounded. It sort of went away and growth came back to running at around 2.5% to 3%. And then the Fed did cut by 50 bips and then didn't do much else. And then now they're kind of sitting on their hands and growth has picked up and suddenly Trump is elected and then it's all about US exceptionalism going in. So this narrative completely reversed and flipped. And it's US is like incredibly weak and it's going to drive a global recession to suddenly the US is going to drive global growth just 3 months later. And as I touched on earlier, but this narrative didn't really make that much sense to us either. I mean, a lot of the policies, it's a little bit of kind of back to the future, going back to 2016 and 2017, and it goes back to the past really. But what we saw with the narrative around Trump in 2016 and into 2017 is very similar to what we're seeing now and have seen in the last couple of months, where if you remember in 2016, it was about Trumponomics and how the US are going to do massive fiscal stimulus and US growth would be amazing and everyone hated treasuries. And then by February 2017, this whole Trump trade just began to rapidly unwind. And actually the dollar, from everyone being very bullish the dollar, it was the weakest currency in the world for the first 8 months of 2017, apart from the Argentine peso. It was the only thing that was worse than the dollar. So, and that's because Argentina was blowing up. So that just shows you how these narratives can shift. And I think looking at where we are right now, we've gone from US exceptionalism and US growth will be phenomenal, and it's touched on European growth or frankly any growth outside of the US is going to be terrible. I think we're kind of in a kind of somewhere halfway where a lot of these, Trump trades, whatever you want to call them, strong US growth trades really have been kind of priced out. But I wouldn't say everyone's now absolutely loaded up to the gunnels in US recession trades yet. The market is still saying that the Fed will cut rates, more than clearly they said before, but only to 3.5%, not the 2.75 that we saw only a few months ago. So we've seen a bit of an unwind of these trades, and then we touched on as well about Europe, where Europe was going to be destroyed by US tariffs, and growth was miserable, and now we've seen actually data improve in Europe, fiscal stimulus discussions, talk about issuance, and we can go into lots more detail on this. I'm a little bit skeptical we're going to see anything like the stimulus that people are now talking about, but European growth has improved, and I think that market positioning is now fairly clean. I think a lot of this unwind has happened. We're not yet at the stage where the markets are now pricing in European growth is going to be 3% forever, but I think we're somewhere in between this shift and pro-US to kind of pro the rest of the world.
Can we come on to Europe a bit more detail in a second, but focus for a little bit longer on the US? And I think we need to accept that policy in the US changes, if not on a daily basis, but on a weekly basis at least. And just for the record, I think we should note that we're recording this on Wednesday, the 5th of March, London morning. So who knows what's going to happen this afternoon.
Or is happening now.
Or is happening now. We're blissfully unaware of it. But I think, given what we know so far and given the trends that we see and the movement we see, Mike, something we talk about with the team on the desk quite a bit is this inflationary? Is it deflationary? You've got spending, whether globally, but particularly in the US, you've got spending maybe on infrastructure and defence, you've got potential tax cuts, but you've also got a shrinking of the federal workforce and other impacts that are offsetting that. So can you just talk a little bit about how you see the outlook for US growth and also inflation versus what the market's saying?
I mean, US economy for the last few years has greatly exceeded what many people thought, and indeed what I thought a few years ago. So, US economy has clearly been able to withstand interest rates in the fives, which surprises me. But we are seeing, I think, rather than taking a view of where in 3 or 4 years' time structural growth, I think, will be in the US, I think what we focus on is more cyclical momentum and what's happening there. So looking at the US economy and policy, like I said earlier, policy uncertainty is clearly damaging. We've seen that in a lot of high frequency surveys, business confidence surveys. Businesses saying they will hold back investment until they have clarity on what's going on. So we are seeing weakness in growth. We've seen soft data weaken quite a lot since around December, but actually now hard data is as well. It's a bit difficult to disentangle exactly what's going on. We had incredibly cold weather in January in the US, and actually also the beginning of February in the US. So I think some of it might just be literally seasonal.
And a lot of wildfires as well.
Yeah, wildfires in California. I mean, they seem to knock off maybe 0.25% of GDP, maybe slightly more than that. So we are going to see that in the numbers. But that doesn't mean we're going into recession. So I don't see enough evidence yet that growth is falling over a precipice. It's just that I think growth is going from 3 to maybe 1.5. Now the question is that priced into markets? And I think some markets maybe are pricing that in. And actually, after the big US Treasury rally we've had, I think markets are pricing in weaker growth, maybe a couple more Fed cuts, which looks about right. But then, risky assets, I think, maybe are still pricing in maybe a 2 to 3% growth environment where, to me, they look a bit vulnerable to continue slowdown. And then, on the point about what Trump's policies have been so far, maybe 3 months ago, the expectation was it was going to be massive corporate tax cuts or tax cuts on the consumer, and this would be buoyant for growth. And actually, I think the surprise has been it's much more about tariffs, which generally global growth negative, as mentioned, and cutting back the government, which is also, I think, growth negative, certainly in the short term and medium term anyway. So no, I think you can see why growth will weaken, not just because of weather, but actually this could be a 6 to 9 month story.
Do you think there's also a sort of restocking effect from after Trump was elected, and there was a sort of supposition that there would be tariffs in the future, that maybe there was some sort of front running of tariff programs and people sort of buying and importing stuff before inauguration?
Yeah,
and they have some sort of strong data in November, December, and leads to weaker data thereafter, or
and a lot of the investment intentions initially in November, December were very buoyant, which were indicating that. And I think you still the trade data in the US where imports were absolutely enormous. So there's clear evidence of some front running of tariffs. I mean, actually, it's one of those weird things about imports being very high is that imports kind of indicate, if imports are really high, it indicates strong domestic demand, but actually the mechanics of GDP calculations are that's a massive negative. So if you now look at things like Atlanta Fed GDP now or other nowcasts, they're looking at US GDP maybe being like -2.5% to -3% in Q1. Now, markets might look at this and go, there's a massive recession and a crash, but it's a bit fake. It is that front running. Yeah. So I mean, other measures that we look at of kind of where GDP in the US is currently running is around 1.7 to 1.8, which is, as I say, is weaker, but not terrible.
Yep.
And so, James, are you seeing some of these macro factors being borne out in your conversations with company managers and sort of the sectors that you cover at a sort of more micro level?
Yeah, I think the problem that management teams face is there's so much uncertainty as to the sort of the path for politics and for business over the next 4 years, that a lot of management teams just don't really know what to do. I mean, they're just like us. They're sort of reading the news every day and thinking, well, so have I got tariffs there? Have I got tariffs here? Have I got am I going to have kind of peace in this region that was at war, or am I not? And so people are sort of responding in very different ways. I think a couple of bits of color that I had heard were that US corporate teams were feeling very, very bullish after the Republican election because they saw, if you remember, there was sort of considerable uncertainty before the election as to A, who would win, and B, whether it would be kind of contested and even, safe. And so kind of a clear winner almost sort of drew a line under that catalyst and allowed management teams to kind of plan for the next 4 years. So there was kind of an area of sort of relief and also bullishness behind a sort of pro-growth, pro-business Republican Party. I think that's probably being challenged now, to be fair, by some of the last developments. But that was one theme, and then I think the other thing is very sector specific. So obviously at the moment, companies that are involved in defence or defence spending are likely to be planning for 4 years ahead. Some sectors are really quite worried. So the auto sector, doesn't really know what to do, where to go, and which regulators to make friends with.
Yeah.
Satellite sector is there's tons of question marks about satellites and competition with Starlink. And actually every company apart from Starlink have been under intense pressure until recently, but now it's seen that possibly satellites could become a sort of systemic defense security issue, and therefore it might actually be quite bullish for all of the kind of regional satellite operators as well. So there's so much going on that I think people are just planning almost on a day-to-day basis.
Is some of that as well driven by regulatory themes? People before Trump thought that there would be kind of a regulatory rollback, increasing M&A activity, that sort of thing. And is that being, I don't know if that's something you've seen as well, the attitudes change over, or
I think
in terms of that uncertainty.
I think so. There is a view that deregulation in the US will continue, and that will be sort of constructive for management teams and management behaviour. I think there may also be a sort of trickle down pressure on regulation in other parts of the world as well, because I think one thing that is quite obvious for kind of European politicians and businesses is we they need to do something to sort of step up to what is a fairly aggressive White House behaviour towards international relations. And I think that might mean that deregulation becomes sort of one way to compete. So from our point of view, deregulation is maybe a double-edged sword, right? So like deregulation is kind of growth positive and risk positive until it's not. So until something goes wrong, like it did with the banking system and can with other companies as well. So we just need to sort of keep an eye on what's happening on the regulatory front, really.
Taking a step back, we, of course, have a whole research team that spends a lot of its time going into companies, grilling the leadership, finding out what's going on. And so a little earlier, I spoke to one of those analysts, John Neve, about how he's finding value in this kind of market.
When markets are strong and spreads are tight, the market is generally open to lots of refinancing. So companies who are maybe struggling a little bit operationally, that are trying to turn around their business, if they have a wall of debt maturities that they have to worry about, this kind of market environment is one where those refinancings can get done, which will buy these companies more time to execute on the turnaround of their operation. And that creates an opportunity for us on the existing instrument, which will get repaid at par, but also on the instrument that is then issued as part of the refinancing, because hopefully the company will use that time to improve its credit profile and obviously benefit the spreads. And the second point I would make is areas of the market that are potentially under research, where people are not necessarily looking for various reasons, but it could include, for example, past issues in a sector, and those issues may have changed, right? So the companies in that sector maybe have improved their performance, and because the market is not necessarily looking, that could present an opportunity for us if we think it's there. And then lastly, what we're really trying to do is identify companies or sectors where there are clear catalysts that will change the market's perception of creditworthiness. And by doing that, one would hope that the spreads would tighten as the market sort of comes to terms with the changes.
Are there any sort of examples that come to mind, maybe past or present, that sort of fit in that framework?
Sure. So maybe I'll give one sort of success story or backward-looking example, and maybe one potential opportunity that we see at the moment, right? So one thing we've sort of seen as a success story is in the aviation industry, right? So there has been a shortage of aircraft being produced in the aviation industry. And so one may ordinarily just look to the companies that produce those aircraft and say, okay, that's bad for them. But I would then try to look at the second and third order impacts of those that event to see if there are any other sectors or credits that could benefit as a result. So step forward the aircraft leasing companies. So airlines have found that they've seen an increase in demand for air travel from their customers, but they're not getting the same number of aircraft from the manufacturers that they thought they would. The aircraft leasing companies own around half of the outstanding aircraft fleet. And so airlines are forced to turn to the leasing companies for more aircraft. And that means that the aircraft leasing companies can obviously charge a higher price for the lease. And that's manifested itself in credit ratings upgrades. So we're now in the middle of a rating upgrade cycle with the aircraft leasing companies, which were historically rated sort of high BB or low BBB. We're now seeing those ratings being upgraded to mid or even high BBB, and that's obviously benefited us as holders of those bonds. They may be thinking of sort of, where is there an opportunity now? So thinking in sort of geopolitical terms, one of the areas that I look at is in the metals and mining sector. So it may surprise you to know in Ukraine, for example, some of the corporates there have continued to be able to service their debt all the way through the war. And even they have been able to reduce the actual amount of debt they have outstanding. So we think that, on the assumption that there is progress towards a peace deal over the next 12 months, those companies will benefit by eventually being able to refinance those instruments at reasonable terms. And the yields on those kind of instruments are still pretty attractive.
So I was wondering if you could just sort of take me briefly through how you sort of, your process for integrating those second and third order effects into your process, because obviously there's a lot of complexity out there and a lot of risk and unknowns. So how do you kind of go about integrating that into your investment decisions?
Yeah, of course. So I think the key point here is that, as you alluded to, facts and events change very quickly, but people's views tend to change more slowly. So there are some inherent biases, for example, in people's views that are slow to change. And so for those investors who can sort of identify that and try to remove those biases, there is an opportunity to benefit if you are able to, like you said, to identify the second and third order impacts and how they may affect the situation. So for me, it's about trying to think logically, try to remove those biases, seek out actively views that are contrary to my own, for example, talk to my colleagues in trading and portfolio management on the equity side as well, and really try to identify those areas that will be impacted by these events and move quickly and accordingly.
Well, John, thanks very much for your time.
Pleasure.
Appreciate it.
Thank you very much.
James, I saw you nodding emphatically during that interview. You're someone who uses John's research, I understand. Do you have an example of sort of how you brought that into your process?
Yeah, so I think he covers stuff across a lot of different industrial sectors, and some of it is at the higher end of the risk spectrum, and some of it is at the lower end of the risk spectrum. Historically, it's interesting because I think sometimes people think of that as being, you can make a lot of money in the high risk parts of the market, like high yield and distressed, but you can also lose a lot of money. Whereas in the sort of lower risk and lower beta stuff, you might make a little bit of a spread, but you're not going to make a lot. But actually, that's not particularly true. So in some of the lower beta, higher performing parts of the market, you can actually make very, very good returns, both on a sort of excess return and a total return basis. And I think that sector that he talked about, the air leasing sector, is one of them. And one of the reasons for that is the sort of the fundamental backdrop that he talked about, that the sort of fundamentals are improving and credit ratings are improving. But another is it's actually quite a sort of volatile space from the point of view of credit spread volatility. So even though most of those companies are rated BBB or they're mostly investment grade, because they have big cap structures, because they are sort of correlated with things like the oil price, with the interest rate cycle, with global geopolitics, they can actually be very volatile. So we have had some opportunities to buy, fairly sort of unrisky companies for very, very high spread valuations. And so that's an area where I think, we work closely with people like John to sort of capture that. And for us as portfolio managers, the main thing is to make sure we have conviction in the health of the company. And then we'll take the sort of information about the sort of spread and the yield and say, well, if John thinks that about the health of the company, then I need to have a pretty big position because the spread valuation is very high. So that's really our main job, is like we can all see what the price is, what's the sort of underlying credit risk below that, to give us comfort to make that investment.
We're all operating in unprecedented times, and we all know that, and we've been told that repeatedly over the last few years. But one of the implications of that is that you get some of the results that he sees coming through are quite surprising. And we've been talking about this amongst the team about, on a macroeconomic perspective, we're also seeing some quite surprising data coming through, and you can actually quantify that, right?
Yeah, so we monitor all the data that comes out, but you have some providers. Citi is probably the most famous, but they have surprise indices. So they have various indices, and lots of other people do these as well. But just an economic surprise index, for those not familiar, at least Citi's methodology is more like a 3-month moving average of whether data comes in above expectation or below expectation. It's weighted a bit more to the most recent data. But my view is that over the last 9 months, there's been so much political noise. Obviously, we had US elections. But ultimately, what's actually been driving government bond yields is economic data. And you've seen that very clearly by looking at these surprise indices, which is why I've actually found them so useful. Really, ever since about mid-2023, before 2023, from 2021 to 2023, what really drove bond yields was actually about inflation and commodity prices and supply shocks. Since around mid-2023, what's been driving bond yields is actually back to how it was pre-COVID, which is changes in demand. And you're really capturing that in these surprise indices. And you found actually the Citi Surprise Index, even though it's a 3-month moving average, has actually tended to lead government bond yields. So, not just for the US, but you see this for other countries as well. So, why have US Treasury yields now dropped relative to European yields in the last couple of months? Some people might argue it's all a political noise, but actually it's because European data has been getting gradually better from pretty low levels. US data has been getting a lot worse from pretty high levels, and I think that accounts for most of what we've seen with bond market moves. So yeah, I think this is why with our macro top-down process, it's trying to screen all the data and get rid of what we think is less relevant, but focus on what we think is relevant. And when you put it all together, you're clearly seeing that bond markets are being driven by this.
Mm-hmm.
And Mike, where you see a lot of uncertainty and a lot of surprises, does that in one sense make the market less fragile? Because we talked about sort of the high consensus potential sort of herding that happened last year. Everyone was into one narrative, and then it switched and the market fell quite sharply. Does that sort of play on your mind, kind of the herding and uncertainty and the tension between that?
Yeah, it's really interesting, and it's really something which you touched on as well, James, when talking about credit. But particularly in macro, everyone can construct a macro narrative. It's almost like storytelling, but actually, in a way, what really matters is the valuations, and does your view on what's going to happen differ from what is already priced in. And when we look at some markets, then there might be a narrative which was massively priced in, which going back to this US exceptionalism narrative, almost everyone's portfolio positions were short treasuries, long dollar, long US tech, long US equities, probably long US credit versus other markets, and that was absolutely priced in. So the reason we wanted to fade this is because maybe the US does grow at 3% for the next 3 years, but that's what's priced in anyway. So for us, valuations is absolutely key. And interest rates is another example. And the market went from pricing in 8 Fed cuts to basically 1. And it's like, well, if US does grow at 3, then the Fed doesn't cut. That's priced in.
Yeah.
But if anything happens to derail this US is amazing narrative, then you can get some huge market moves, and that's actually exactly what's happened in the last month, where bond yields have had a huge move, and US assets have underperformed from having outperformed for a long time. So yeah, I think absolutely looking at risk premium everywhere and trying to take a view on the base case of the next 6 months where growth is going to go, but then see what is priced in by different markets is absolutely what we do.
And given all of that, and given the ever-changing tariff trade environment, it would be surprising if currencies didn't move a lot. So can you just briefly talk about the dollar, your outlook for the dollar, and other impacts that might have on other parts of the fixed income world?
Yeah, and what we've seen in the last 2 or 3 years, which is what you normally see, is that currencies, particularly for G10 currencies, and to a lesser extent some EM, have been driven by rate differentials. So in other words, I mean, the classic is dollar versus Japanese yen. If you look at since 2021, the US dollar versus the yen, you can replicate on a chart. If you put that versus 5-year or 10-year Treasury yields, it's the same thing. So it's what has been driving the dollar for the last 3 years is that the Fed has been, the market expects the Fed to hike by more, and the Fed has been hiking by more than other countries. So that's what drove the dollar strength. And this narrative around US exceptionalism then kind of feeds off that. Is really all because the Fed was hiking more aggressively than everyone else because growth was higher and there are, I guess, maybe higher inflation risks too. What we've seen, this positioning is kind of on some measures like the longest of the US dollar that there's ever been. And that is a cause for concern because, again, if there's anything that dents this narrative, then you can get some very, very big market moves, and that's starting to play out. So we have had the dollar going from, frankly, what has been a rally ever since about 2014, when Bernanke first started talking about getting off a zero bound. That's been going on for 10 years. But we're seeing a little bit of a drop in the dollar as the market is starting to think about, well, US growth maybe isn't so strong. Maybe the Fed is going to cut. And look, everyone else is actually doing slightly better than we thought. So I see really the movement in the US dollar as being very linked to what happens to Treasury yields relative to other government bond markets.
So modest US growth, potentially a weaker dollar. Emerging markets are potentially quite interesting.
Yeah, and that's one of, within risky assets, that's the one area that we have been adding to in the last month or so. EM has been loathed by most investors for the last 10 years, largely because the dollar has been so strong. So one of the main drivers for EM, particularly EM currencies and EM local currency bonds, is the dollar. If the dollar is going up, then EM currencies tend to go down against the dollar. And that is why investors are just not allocating to EM local bonds at the moment, which is partly why now valuations actually are looking very cheap. Now, there are some self-inflicted wounds out there. A lot of EM countries, like a lot of DM countries, have been running large deficits, and they're not able to run the same debt levels as DM. They are more vulnerable to capital flight if you start getting into solvency problems. DM doesn't really have that, or hopefully not anyway. So I think we're now in a situation where if US growth does fall to around 1.5, that is kind of the Goldilocks for EM, where the dollar is weaker, treasury yields are lower, growth is weaker but not too weak. Then I think that is probably the sweet spot for emerging markets. And one other point to make is that growth, I mentioned, has been picking up outside of the US, but actually, China data has been getting a bit better. I'm actually not a China bull where I think we're going to go back to 7 or 8% GDP growth rates. I mean, officially, China is growing at around 5%, and they've reiterated again just in the last 24 hours that they're going to keep at that. It's hard to know what's going on with the Chinese economy because any useful data is discontinued that we used to look at. Nevertheless, Chinese data has been picking up, and again, that is also probably positive at the margin for emerging markets.
And James, for you, are you also looking at EM in terms of attractive opportunities there?
Yes. So in my space, it's more about emerging markets hard currency, which is more about credit risk than it is about FX and interest rate differentials. But I do think it's an interesting part of the market. It's a bit of a dilemma. So when you speak to EM investors, dedicated local EM investors, I would think a majority of them will tell you that valuation is quite expensive in hard currency EM, and that's because just like in DM versus its own history, it's performed pretty well. So when you look at it kind of over the long-term history, the spreads are sort of at their tights or close to their tights or in that area. But when you look at emerging market valuations in terms of spreads or yields or what have you, they all look a lot better than developed market valuations, particularly US investment grade and US high yield. So basically what that's doing is it's encouraging sort of non-dedicated buyers, such as myself that look at global credit, to think, well, actually, that story is not that bad and that valuation is not that bad. So maybe I could consider allocating some capital there. And given if you do share that view that Mike has, that possibly Treasury yields have hit their peak and the dollar might have hit its peak, then possibly you get a kind of confluence of events that means that emerging market assets can outperform as well. So yeah, it's interesting. It's sort of tight historically, but cheap on a relative value basis, and maybe you have some tailwinds from some of those international effects as well. And then a final thing that I would say, and going back to one of the points you made earlier about sort of herding and consensus things, is that one of the things that's happened with the Republican administration in the last 3 months is they've continually sort of made headlines about certain countries, whether that be Greenland, Denmark, Europe, China, Panama, Colombia, what have you. There's always a country that's like in the spotlight, right?
Yeah.
And that's led to quite a bit of volatility in those names and countries and sovereigns and corporates when they're in the headlines. But actually, on an underlying basis, not that much is honestly changing. There's a bit of pressure applied about immigration or about the Panama Canal or about Denmark's relationship with Greenland or whatever, but not that much is changing, and yet you're just able to buy some of those sovereigns or corporates in those countries at cheaper prices. So we've been sort of taking the other side of that trade, if you like, and trying to build some positions when countries are in the spotlight for some of those headline reasons.
And talking of areas that are in the spotlight, I think, again, we should recognise that there's a lot going on in Europe. And there's pressure to increase spending on defence across the board. Germans are trying to take some moves towards that, as are the European Union in general. Mike, can you just talk briefly about how you see opportunities and potentially, who's going to buy all these bonds that they're going to issue? Is it going to be you?
It's starting to be, actually, yes. So as I mentioned, the narrative that we were fading was that US would be growing phenomenally well and Europe wouldn't, and the market has been moving towards repricing US rates lower and European rates higher, and just in the last 24 hours we've seen a really monumental sell-off in Eurozone assets, particularly German government bonds, on the back of announcements of 500 billion euros of infrastructure spending and potentially 200 billion euros of defense. And it's kind of, I mentioned earlier, but it reminds me so much of 2017, where, again, remember, Trump 1.0 was all about US infrastructure spending. And that's what drove this narrative of Trumponomics, was how US is going to do huge infrastructure spending, it's going to drive US growth for decades. And what happened? Pretty much nothing. It's not, you can't just turn the taps on and do half a trillion of infrastructure spending, and it's not that easy. And even what's been announced so far, 500 billion euros over a 10-year period, and that's kind of roughly 1% of German GDP, per year. It's not that much. And then on the point of defense spending, this is where Trump actually has, I think, succeeded in a lot of his aims, where he's essentially got the US to have to do less bond issuance to pay for military defense for Ukraine, and has shifted that to Europe, where now they are issuing bonds to do defense. And I don't think that's going to benefit the European economy that much. It takes a long time to build up different defense infrastructure. A lot of that money is actually going to end up in the US. So you've got Germany and Europe borrowing lots more money, where the benefit of that is probably the US economy as much as the European economy. So I don't think it's going to necessarily drive growth. In terms of the question of who's going to buy these bonds, if for German government bonds, where you really assume there is no solvency problem, bear in mind, Germany debt GDP ratio is 62%. That is staggeringly low. The UK is about 100, US is approaching 130, but it goes up a lot every day, obviously. There's not a question of solvency whatsoever for Germany here. So for investors such as myself, it's like, well, what is the yield? Where would you start to allocate money to German government bonds rather than, say, US government bonds? And we're getting to that inflection point for me, where I don't believe this is going to drive German growth kind of 2 to 3% forever. Absolutely no chance. You might have a bit of an uplift in the next couple of years, but German government bonds at 3%, given the structural growth problems that Eurozone has got, well, this isn't going to change anything. It's starting to look interesting. So we have actually been covering our underweight to German government bonds and European government bonds, and I think that is becoming a bit of a sweet spot if this narrative continues and European bonds continue to do badly.
I think that is a point that's sort of interesting between sort of government bond dynamics and credit market dynamics as well, because I think we probably all share a view that there's a lot of debt in the world. There's probably too much debt in the world, but whereas that had historically been kind of corporate and possibly household driven, there has been a sort of transition towards that being kind of government balance sheet driven at least in many countries of the world. So debt to GDP in the US is at 100% or whatever, and the deficit's about 7%. I think is like the highest level of peacetime metrics on both counts or close to it. So you've got this kind of cool, the credit market, again, going back to like, why is the credit market so expensive? I think it's because that market is not growing, and in many parts of the world is actually shrinking, whereas the sort of government balance sheet and the government deficit spending sort of continues to rise. So you probably wouldn't ask that question to me, like, who's going to buy all those credit bonds? It's more of a question who's going to buy all those sovereign bonds, and that it doesn't mean that they're bad value. Quite the opposite. They're great. They're probably great value because real yields are high and growth expectations, probably not that high either. So the sort of real yields available are pretty high. But you do have a totally different supply-demand dynamic than you do in the credit market.
I think it's a really good point, and it's probably less relevant for a high-yield investor such as yourselves, but I think for an investment-grade corporate investor, you're going to get to the point you probably are already, where you find some, let's say, German corporates are trading with a yield below French government bonds.
Yeah.
So, it's actually starting to crowd out potential, where's the money going to go? It's going to chase the biggest yield. Well, the biggest yield for years has been in corporate bonds versus sovereign bonds. But we could be at the point where people actually allocate to government bonds. So that government supply actually will affect credit as well.
Yeah, definitely possible as well, yeah.
Great. Okay, well, thank you both very much. We've covered a huge amount of ground there. I think trying to sum all of those comments up together, I think we would say from a macro perspective, slightly softer growth outlook as we're looking forward, definitely changes in policy. Credit spreads, in your mind, Mike, seem to be fully valued and not of very much investable interest. James's perspective is slightly more nuanced, and it depends where you're coming from and what your reference point would be. And there are pockets of value there to be found if you're prepared to do your homework and pick your spot. I think one thing that is pretty clear is there's going to be volatility. So as active investors, we ought to be able to be well placed to take advantage of that and invest our portfolios accordingly.
Yes, brilliant. I think that's almost all we have time for today. But before we let you both go, you have to play the Fidelity podcast game, Hot Cakes and Hot Potatoes. We'll do it very quickly. Each month we ask our investors to pick something they would buy, a hot cake, fresh out of the oven, and something they would drop, the dangerous hot potato. So, Mike, turn to you first. Your hot cake.
Hot cake in sovereign bond space. The bond market I like the most is actually here in the UK. It's gilts. So that's the one that we're most bullish of. UK defence spending is already pretty much at the level that Trump is requiring, and supply isn't particularly an issue. I think actually you could get some fiscal consolidation in the UK, which is a very big contrast to almost everywhere else at the moment. And I think we talked about it already a lot at length today, but in terms of valuations, I think credit is the area that I would look to avoid. I think in fixed income, taking a global go anywhere perspective, I think there are better risk returns out there.
So that's your hot potato. Yeah. Okay, fantastic. And James, same to you. Your hot cake, please.
Yeah, sure. The hot cake would be a deeply unpopular part of the fixed income world, which is long bonds in emerging market sovereigns. And the reason why is because I think people have completely lost patience with that over the last 4 or 5 years with interest rates picking up, some low coupon bonds like really underperforming by a horrendous amount. And not many people are paying attention to them now, to such an extent that you can have, a combination of things that as bond investors we really like, which is, very low cash prices, very high yields, even very high running yields, which is the sort of the coupon divided by the current price, and not much credit risk as well. So you've got a lot of convexity and upside in stuff that is not that risky from a credit risk perspective.
And your hot potato? Can't let you leave without one, I'm afraid.
Yeah, so I think that you actually see quite a lot of value in Europe in the sort of distressed and triple C part of the market, but I think the area of the market that is close to that and rated single B on average is pretty expensive. So if you look at that both sort of historically versus other parts of the world, versus its own history, and certainly versus stuff that's a bit worse rated like triple Cs, it screens as pretty rich. And obviously that's the part of the market that is only one step away from, going into a sort of more stressed part of the landscape as well. So I think in that area we're being very careful at the moment.
And then can I ask both of you to recommend one item to read or watch or listen to, something that's grabbed you recently? Can be anything at all. Mike?
So I think most people at this point would talk about all the finance books they've read and whatever the hot macro theory is that people are writing about. And I'll openly admit I try as much as possible not to read about finance, given that I spend my entire life at work and outside of work doing that anyway. So currently actually going through F. Scott Fitzgerald's books, and on the film side, given have a young family, then been dusting down 1980s classics that my children haven't been watching at school yet when it's raining. Flight of the Navigator was last weekend, which is a classic that I would definitely recommend.
Definitely. James?
So I have been reading books about climbing for some reason, even though I'm not a massive climber myself. And every time I read a book about climbing, someone will say, "Oh, you've read that, you need to read that as well, because that's brilliant." And so the last one I read was called The White Spider, which is about the first sort of successful attempt to climb up the north face of the Eiger, which is a pretty amazing story. But they also document all of the unsuccessful attempts to climb up the north face of the Eiger as well. So it's a pretty harrowing read, but it's pretty amazing.
There's probably a metaphor there about challenging ascents and markets, but we won't go there.
All of refinancing.
Well, that's pretty much all we have time for. Thank you very much to Mike Riddell, James Durrance, and of course, Jonathan Neve. You can find more information on fixed income strategies and investments on your local Fidelity website or at fidelityinternational.com. We hope you've enjoyed what you've heard today. Please do share and subscribe wherever you get your podcasts.
The producers today were Holly Eastman and Patrick Graham, with production support from Adam Sheldrake and Alex Wilcox. The editor is Seb Morton-Clark.